The value of home prices to income, that ratio, is the highest it's ever been, obviously for the reasons I just mentioned. And in order to keep those asset prices from falling to a level where the free market needs it to be, to exist in a natural free market economy, which we don't have, I have my doubts that they'll ever let it happen, at least voluntarily, they being the Treasury and the Fed. You need this monetary fuel. Well, I just mentioned that the monetary fuel is being cut off. So if you look at the shape of the yield curve, banks aren't really incentivized to lend when their funding costs are higher than what they get when they make a loan. And they're not making many loans. I mean, yeah, now they can make a loan at 6.87% for a new mortgage. But have you looked at the level of transactions over the past few years? If you're sitting with a mortgage that's 3%, what's your incentive to go out and get a new house and pay 7%? And the prices of these houses are astronomically high, astronomically high. You know, when you throw in maintenance costs, the taxes, insurance costs, through the roof, they're unaffordable. So out of reach for the first-time homebuyer. The middle class has been eviscerated by all of this inflation. For the first time, and I'm 60 years old, been licensed since 1991. The top quintile is okay because they're hanging in with those asset bubbles. But the spending power of the bottom 4 quintiles has been eviscerated. That's why you see all these companies coming out, like McDonald's even today, and American Airlines. There's a parade, a plethora of companies that just tell you the consumers on their heels. And here's the thing, inflation price level has wiped out the middle class, and it's still rising at a level that's at a speed, a rate of change that is greater than what the Fed wants it to be. And what the people need is for prices to fall. So they're rising higher and faster from a level that's already rendered their purchasing power and their living standards in penury. So that's the problem. That's why the Fed can't really say, I'm going to cut interest rates and everything's going to be okay. Well, first of all, effective Fed funds rate is 5.3%. Do you know what the 10-year note is today? It's 4.18, and the 2-year note's 4.4. So the market, whatever free market there is left, the vestiges thereof, has already priced in these rate cuts by the Fed. And we're still seeing the transaction market for real estate frozen. Equity prices, if you look at the total market cap of equities as a percentage of GDP, just below 200% a few days ago. In 1929, it was a little bit above 100. And in 2007, it was a little bit above 100. And even in the NASDAQ bubble, it was like 138% of GDP. So we've never seen total market cap of equities as a percentage of the underlying economy be anywhere near 200%. And here we are today at 200%, twice the output of the economy in a year. And I mentioned, of course, the credit bubble, record high levels of corporate debt and business debt, private equity. These are all massive bubbles that are predicated on negative real interest rates. Basically, what that means is that I can borrow money at X% and I can invest in anything that mirrors inflation, commodities and stocks, real estate, and make money. It's basically free. That situation has changed. The monetary fuel is being cut off. Money supply growth has crashed. Bank lending standards are tightening. Fed's balance sheet has shrunk from $9 trillion to $7.2 trillion. And the level of the real Fed funds rate is positive fuel, which is what you need to keep these asset bubbles afloat and growing. And it's no longer. There's never been this triumvirate of bubbles that all existed concurrently. Like I said, so if you go back to 2000, it was the NASDAQ bubble. It wasn't even an equity bubble because it was, it wasn't in the it didn't manifest in the S&P. The bubble was created and manifested in NASDAQ stocks, Y2K stocks, okay, in particular, and the internet bubble stocks. But that didn't stop the NASDAQ from dropping 80%. And it didn't stop the S&P from dropping 50%. And then you fast forward a few years and they took interest rates down to 1%, left them there for like 2 years, engendered the housing bubble. Well, we didn't really have an equity bubble then or a credit bubble. We had a housing bubble. And the housing bubble burst, and that dropped, home prices by 33% nationally. But that didn't stop the S&P from falling 50%, even though it wasn't the nucleus of the bubble. Well, now we have, like I said, these 3 bubbles existing concurrently and in record proportion. So yeah, this is the most dangerous time in history, and by a lot. If you look at the ratios and you bring them back to historical home prices, and equity prices would have to fall 40% each. And that would just bring them back to somewhat, pretty overvalued levels. And things never fall down to, the mean level, they usually tend to fall below. So, and I think that is why Powell's so panicky and is looking for reasons to cut interest rates, because it isn't because inflation price levels are back down to where they were prior to COVID. It isn't even because CPI is back to 2%. As a matter of fact, core PCE was actually accelerated. But he's panicked because he knows that private credit, which was a non-existing asset for his instance, was non-existent asset. Now it's like $1.7 trillion worth of private credit out there. That's basically non-bank lending to businesses that are highly leveraged and very poor credit ratings. They can't go to a bank and they can't float loans themselves. He understands that. So I guess the calculation is, for the middle class, is it's Wall Street first, it always has been, and it's Main Street last. So what you're seeing is this evisceration, this bifurcation of the economy where you have the top 1%ers doing pretty damn well. Their houses are doing great. Prices are still rising for their homes. And the equity market is doing pretty well too. It's doing very far from all-time highs. But ask the average person out there. Well, we're in a bear market and the economy's in a recession. Because for them, it is. For them, for 25% of Americans, they are having to cut back on food consumption and medical care. That's a lot of Americans. 1 out of 4 Americans are having to put things back on the shelf when they go to the grocery store and they put you take that off the belt there, take that off the belt. Sorry. That's terrible. And Powell is saying, I guess he's making the calculation, like, I have to keep the private equity and the banks, try to make them as solvent as possible. Because after all, if the banks go down, it would hurt the middle class. Well, it would. But what other choice do we have? When are we going to live in reality? Are we going to become like Venezuela, Argentina, Zimbabwe? What are we going to do? What's our choice? I think the choice is to rip the Band-Aid off and let the depression occur, reduce the asset price levels that are out there so they can be affordable again, default on a lot of this debt that's unserviceable when interest rates are, normalized. But that would be very painful. And what politician is going to go up there and say, hey, vote for me? They have a 2 or 3 year depression, and a lot of people will be hurt and starving, and civil unrest will occur. But, on the other end of that, we'll start again. We'll reset the debt levels, we'll reset asset prices, reset the currency. We'll do all those resets, and we have a chance to have a long and viable, healthy economy that has low taxes, low interest rates, low inflation, stable currency. Wouldn't that be lovely? Even Zimbabwe, after their parade, their recidivism rate, which is 100%, where they redid the currency, hyperinflation, and then they started all over again, and the currency was destroyed. They did it over and over again. Even they have now linked their currency to gold. I give them credit. I hope it takes. I don't have a lot of confidence, but let's live in a reality where when you think about money, you look at high-powered money, which is base money supply, which is the building blocks of all bank lending and all the other broader aggregates. So the base money supply, Fed's balance sheet, was $700 billion in 2007. This is the building blocks of all money. They took that from $700 billion to $9.2 trillion. And this makes Zimbabwe blush. Why would you do that? Why did you need to enact serial helicopter money launches where, after COVID, we knew COVID was over. The masks were off. You could stand, 5.5 feet close to people, not, 6 feet. Yeah. People didn't have to, they got out of their houses and they got out of their caves and you wouldn't see people driving in their car alone with a mask on anymore. And COVID was over. And you still had politicians spending trillions of dollars trying to get the economy going. And that was monetized by the $6 trillion was spent and $4.5 trillion of it was monetized by the central bank with alacrity. It's a shame on us. If the Fed was to cut interest rates, I think they're threatening to cut interest rates a few times between now and the end of 25. I think they start in September, maybe they go in December, that's 2. Maybe they do 1 or 2 more cuts, even if it's 4. Even if it's 4 cuts, you're down to 4.25% on the Fed funds rate. Well, we're already there. And so, like I told you already, the free market has already taken rates to 4.18% on the 10-year note as before I got on this interview. So how much lower is the 10-year note going to go? And here's the thing, because we are an insolvent nation now, thanks to what they've done to combat, well, they started actually in 1987, but we had the crash in 87, but 2000 and 2008 and 2019. Remember, they were cutting rates in 2019 before anyone heard of the China virus. Because of all the things that they have done, America is now an insolvent nation. Assets minus liabilities is negative. If you look at our revenue, The debt as a percentage of revenue is 730%. That is incredible. And we're adding to that 40% per year because of our deficits. We have $1 trillion in interest payments, $2 trillion deficits. Do you know when the recession does arrive, if the business cycle hasn't been abrogated and annulled forever and ever, amen, we're going to have another recession. Do you know that their deficit is going to be $4 to $6 trillion, the annual deficit? How the heck are we going to afford? So the America is an insolvent nation, and we're just coming across inflation that was 20%. We're just getting over that rate of change of 20%, which is a record high for this country. It was 9 officially, I get it. But you don't believe that because you're way too bright. You know, and everybody else knows that the home prices are up in the last 4 years by 47%. And food prices are up 40%. And insurance is up 20-something%. So don't say 9. It's 9 because the trim, mean, hedonically adjusted, substitutionalized, bastardized CPI is 9%, was 9%. Now it's, 3. Congratulations. So what I'm trying to say is that if the Fed was to do that same playbook all over again, they're doing it from 2 new launch pads. One is an insolvent nation that has been ravaged by inflation. So go ahead and slash interest rates to 0. Go ahead and go back into QE. Go ahead and launch helicopter money. And you tell me, what does the 10-year note do? Does it stay at 4%? Or does it say, whoa, I know where this is headed, buddy. You can never conquer inflation. I think the 10-year note can rise. That's new. Because the salve, the mollifying agent here to remediate a recession is to bring interest rates down artificially by printing a bunch of money. What if you do it this time and it doesn't happen? I think the odds are significant that it doesn't on the long end of the yield curve.